In today's video, we are going to look at a case study that is based on an actual case that I recently worked on. It's for an individual who is interested in a whole life insurance policy for maximum cash value, but really two things we're going to look at. One is the product selection. So he narrowed things down to a Guardian policy, really likes the flexibility, but what we're going to look at is the two different options with respect to their PUA rider fee. One, you'll see more cash value up front and stronger guaranteed values. And then one option, you'll see less cash value up front, but more money long-term with an identical design. So same base premium, same death benefit, same MEC limit, just different PUA rider fees, which will be interesting. So one, we'll look at that. Relatively simple case regarding the actual specs here. So we've got an individual, 47 years old, healthy, regular preferred rating. And the funding we're looking at is a total of $250,000 going into the policy, but $50K per year for 5 years. So that's the funding. And then step two is actually using the policy. And what will be interesting here is we're going to look at our loan workbook so we can actually look at the two different product options and see how that impacts his ability to be able to access cash value. Meaning if he goes with the option that gives him more money up front, he'll see exactly how much more money he has up front, how much more he has access to, and that'll help him make his decision. Just through the years of working with individuals, I have seen a lot of business owners and individuals who have an entrepreneurial mindset really value that upfront cash value because a whole life insurance policy at the end of the day is a safe, liquid, tax-free area you can position money, tax-free if you do everything right, don't trigger a taxable event, but it's going to produce somewhere between, call it 3 to 5% as far as the net internal rate of return at the end of the day, the net growth rate. So the question is, how do I accelerate that growth rate, have access to more cash value? This way, when an opportunity comes around, I don't have to worry about a big upfront hit or not having access to all of my cash value or as much as possible. Because how a lot of business owners view it is, if I have to take a big hit up front, I might as well leave the money in cash because that's how my business grows. I want access to capital. So if I can minimize that upfront hit and still get the long-term benefits of a cash value life insurance policy, I'm interested in that. So we're going to look at options that hopefully will help you refine that decision-making process with respect to accessing the product. So the company we're going to look at here, I said accessing the product's cash value. We're going to look at Guardian, their L95 policy, which sometimes I will refer to as their hybrid policy. And with this product, this is the only product as of the date of shooting this video. They've got two PUA riders available. And whichever one you select, you are locked into for life. So they've got one at a 10% fee. That is a gross fee, meaning if you were to pay in $10,000, you will not see $1,000 taken off the top. And you'll see that in the illustration. But one with a 10% fee, and then you've got another one with a 5% fee. So which one would you select? Well, on paper, just about everyone would select the 5% fee, less of my money going out the door in PUA rider fees. However, when you look at a higher PUA fee, the way that it is positioned or the way that it's sold to us as a consumer, so the insurance company pitching both you and myself saying, hey, here's why you might want to consider a higher PUA fee, is if you select the higher PUA fee at 10%, what you're doing is giving the insurance company more of your money up front. A higher fee results in less of your payment showing up in cash value right out of the gates. So they're taking more up front, but then the insurance company is saying, based on what we think we can do with this money, we will give you greater long-term potential. Meaning when you look at the non-guaranteed side of an illustration, the higher the PUA fee, the greater the long-term results are, again, on the non-guaranteed side of an illustration. If you were to look at the guaranteed side of an illustration, though, the lower the PUA fee, the higher the cash value. So it is a determination. It's a question we have to ask ourselves, and we've got to answer it for ourselves as well. Which one do I prefer? And you might decide to split it if you want to. If you say, hey, I'm going to pay X amount of dollars into a policy, let me just split it 50-50. I'll put 50% of my cash flow into a policy with a 10% fee, and then the other 50% into a 5% fee. You can do that, but it's really seeing the different options up front and choosing which one is best for you. So first we'll look at the difference here on both a guaranteed and non-guaranteed basis. And then we will look at using the policy via loans, and we're going to look at a cash value collateral loan with our loan workbook. So let's have some fun here. What we've got first is the standard Guardian product with the standard 10% PUA fee. So let's zoom out a little bit here so we can capture everything. All right. So the funding we've got. What do you notice here? Net after-tax outlay, $50K per year for 5 years. Total out-of-pocket right here, $250,000. Now, what we see in this option, base premium right here, $4,500 and change. Where we came up with that number is because the maximum PUA payment we can illustrate on an annual basis is 10x, whatever the base premium is, provided we have a 1-year term rider attached. I should rephrase. I just want to be transparent with this. It's 10x with the exception of the first year, where we can go up to 50x. So with that said, we've got it designed to max it out for 5 years here, $50K per year, and there's our minimum base premium. We've got a term insurance rider attached right here. Here's the cost of the term rider, about $400 in the first year, and you will see it decrease in this example as the term rider cost decreases. Net cash value. When is your break-even point when you look at this? Year 5. You've paid in $250,000 and you have $250,000. Now this is the standard PUA rider with the 10% fee. I'll show you exactly how you can identify that in a second. But a couple things I want to hit on first. Base premium. Keep this in mind. Base premium. Whole life death benefit. Term rider. Net death benefit, $900,000. L95 product. Let's look at the same product, but with a lower PUA fee. There we go. So if we go back, so again, standard, 5% PUA fee. Do you notice any difference with that whole life death benefit, term rider death benefit, base premium, PUA rider, anything? No. Everything's the same. Look at the net death benefit. And again, it's an identical product. The only difference here is you'll see STP under the paid up additions rider, which stands for Steve and Tara Parisi. My wife's name is Tara, so they actually named it after that. I'm kidding. That's totally not it. That stands for short-term performance, and you'll see why in a second. But here we go. That's the only difference here. Term cost, right there, just about $400 as well. Now, when we look at the difference here, what jumps out at you? For most, it'll be that first year cash value. Looks a lot like the old Guardian product with the upfront value, break-even point, year 4, really between years 3 and 4 there, rich upfront cash value. And this is based on the present dividend scale, the non-guaranteed values. All right. So we can also take a look at, on the illustration, the guarantees, which we'll see the custom guaranteed report here. The break even, this is based on a regular preferred rating, so close to year 6. If we look at the 10% PUA fee, here we go. Just about year 9 there when we're positive. So rather than scroll back and forth here, let's take a look at a side-by-side comparison. So what we've got here, let's start with the dividend values actually. This will make it much easier, one at a time. This way it doesn't come off as overwhelming, because I know it can be. On the left, what do we have here? Dividend values. Dividend rate with Guardian, 5.65%. L95 policy, 5% PUA fee, and then the 10% PUA fee. What's the immediate difference with cash value? $44,000 and change in cash value, that's almost 90%. Over here, a little less than $42,000 in cash value. It's a bigger hit up front. Break-even point, almost a full year earlier. It is a full year earlier. Year 4 to year 5. Now, if we really want to break this down, let's look at year 2. So here, I should back up. Year 1, you pay in $50,000, you've got $44,000, which no matter how we slice that, it's a $6,000 hit. Year 2, let's isolate this. You pay in $50,000. It was $44,064. You paid in 50. You got your 50 back because it's 94 plus almost another $900, meaning it's positive by the second year. Whereas over here, check this out. Year one, you paid in 50. You had $41,750. You pay in 50 again in year two. If you get the full 50 back, it would be $91,750. We get our 50 back minus about $1,000 here. And then by the third year, it begins to become positive there. So that's really where the difference is, which you might look at that and say, hey, who cares? But you might also look at that and say, no, that's noticeable to me because I don't like the idea of taking a hit on my money the first and second year. Maybe not even the first year. So the more we can minimize that, the more attractive the product might be. Or you might look at this and say, you know what? I know that this is non-guaranteed over here. However, if I look at the year 10 mark, what's the difference? Well, the short-term option is stronger. If I look at the year 20 mark, now that long-term option is stronger based on non-guarantees. Keep that in mind. So, exact same thing here based on the illustration we just saw. But what do we notice now? Well, the first year is identical. 50 in, 44 in cash value. 50 in, 41,750 in cash value. What is highlighted in yellow represents your break-even point. Lower PUA fee, so close, by year 6. Higher PUA fee, year 9. So there is a difference there. I mean, you could argue this is between years 6 and 7, because it technically is, and this is between 8 and 9. But still, I see a difference there, and if I am interested in a whole life insurance product, because of the guarantees, I view it as a place I can position my money. I'm really laser focused on the guarantees as a worst case scenario. Then that 5% PUA fee will look more attractive, especially if we're looking at larger numbers, then you'll really see it amplified more. But when we look at this, 20 years in, you're at $345 with the 5% PUA fee compared to $327 with the 10% PUA fee. So close to about a $20,000 difference where you've paid in a total of $250K. That is noticeable as time passes. So that's the kind of stuff I do want to highlight up front and be made aware of it. If we like to look at this from a percentage standpoint, let's look at this. Let's just do it with the dividends for this example. Let's take a look at our IRR formula. So this will just isolate the annual internal rate of return, not the average. And here we go. So here we've got the 5% PUA fee. What's the hit in the first year? 11.887%, just about a 12% hit when I look at my total input, $50,000, and I've got $44,000 in cash value. Okay, year 2 though, I am positive. Whereas if I look at this guy, there's the difference there. I'm negative for the first and second year. However, as time passes, this is the kind of stuff I want to be made aware of. What's the difference there in IRR? In this particular case, it is noticeable. Annualized basis, I mean, you're over 50 basis points more per year. And again, based on non-guarantees, that's the big thing. So we've got the IRRs annualized side by side. If we look at the average, the difference is not that drastic. It comes out to about right around 30 to 40 basis points. It does depend on your age and such. But again, it's good to see this up front because if he wants to use this for real estate, and wants access to capital up front, even if his plan is not to use it. He just likes to see it there and likes the idea of funneling money into a policy for all of the benefits that it provides. Well, that's where I want to see both options. So here we go. This is the 5% PUA fee. Now you can tell, first year, 50 goes in, you've got $44,000 in cash value. Now we've got the loan workbook over here. And this is not based on the insurance company software. This was created to demonstrate how cash value collateral loans will work. They're not exact numbers because they're based on the loan interest rate. Interest is based on an annual basis, not a monthly basis. So, I mean, this is meant to just provide a quick snapshot. But what we've got here, payment, annual payment, total payments, you get $250K into the policy. Cash value, there's your break even year 4. Death benefit, annualized internal rate of return, then the same thing but in dollars, cash value growth, and then a cash value gain, which represents how much did I pay into the policy, $250. So let's look at year 15. You've paid in $250. You've got $381. That's a difference of $131. That's the cash value gain on the policy. So here, if I want to look at loans, the only thing that we have to change here is the annual loan repayment, and then the interest rate if we would like to change that over time. So if he's got a deal, let's say in policy year 3, and wants to pull out $100,000 based on the available equity he had, he can. What this $39,781 represents is how much more he can take out in policy loans or policy loans. Draw down on his line of credit with the bank if he wanted to, because this assumes a collateral assignment. So we've got a 6% interest rate, 6% of $100,000, annual interest due, $6,000, annual interest payment, $6,000. So what I want to look at here, there's the cash value growth that year, $2,200. I paid $6,000. Did I come out ahead or behind? Came out ahead. Now, if I pay interest only in this particular case, what happens here? Eventually, the gains on the policy, the annual gains, exceed what I'm paying in interest. And the reason why, because if I look at this, here's your earnings rate, annual IRR, compared to cost to borrow. The cost to borrow is higher. But this is where the total dollar amount will come into play. If I've got a $100,000 loan outstanding, but earning on this full cash value, yes, a smaller rate on a larger bucket of money, it'll give you a greater return on cash value. When I say return, a greater dollar increase specifically. So we've got the increase here, but let's do this. We paid in $250,000 here. Let's take out another loan of $150, and let's do it at year 6 here. The reason why is because we paid in $250, we pulled out $250. So what I want to know here is if I try to make it not work, how long does it not work here? So I'm going to pay interest only in this particular case, which we do want to start to repay the loan, but here in purple are my annual payments. If I compare those to the annual cash value growth, what do I notice? Take some time before I see the annualized growth overtake what I'm paying in interest. Now, the same is true with this. Total interest payments compared to your total gain. If I look at, it's just about by year 25, the two are just about equal. Now, we deliberately here tried to put ourselves in a situation where it would not make sense or take a long time before we see the value. If we are repaying the loan, let's assume we begin to repay it, so we fund it at 50 for 5 years, then we've got our loans outstanding. Let's start to repay it, year 7, at $30K per year. What happens here? There we go. Loan is paid down. And what happens is as we are paying that loan down, less is paid in loan interest. There's my annual interest cost. The policy keeps on moving forward. So obviously the gains will outpace the actual interest due. And the total gains on the policy will exceed the total interest payments. Now what you can do if you are trying to weigh your decision based on the different products available is let's take the 10% PUA fee, copy those values, and watch this. Paste it in. Take note of these 3 columns. Annual IRR, cash value growth, and cash value gain. Voila! Isn't that cool? Everything updates here. So now I can see the annual internal rate of return. I see the cash value growth, which I can compare to the loan interest over here. I also see the gains, which are further behind in the beginning, but then they look better long term because of that higher PUA fee and how it functions. The purpose of this is really to show the different options and help one make a determination as to which option is best for them. That's really my favorite thing to do when we look at the different options. Of course, we can always provide a recommendation and let you know exactly what we do and what option I pick, which if you've worked with me and asked me, or if I told you, you know that already. I do hope that you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.